Hey everyone, Steve Taylor here. I'm the founder and lead advisor over here at Merited Wealth. So there's been a lot of news lately, and there's a lot of fear and a lot of uncertainty out there in the market regarding a few bank failures that occurred. And really what I want to take a moment here is to talk about, kind of illustrate, what happened, why did it happen in particular to these banks, and what can you do about it? Okay, now that you're feeling that I need to do something. I'm uncertain of what's happening. So that's what I'm trying to, put some information out there to try to help you out, make you feel a little more comfortable in what you might be able to do. So first and foremost, what I want to say is that this is not a repeat of the 08-09 financial crisis, okay? That was a systemic failure around the issuance of mortgages that permeated every single facet of the banking industry. That is not what this is, okay? So I know it might feel like it, the same fear, that was, around back then, maybe is coming back up now, but first and foremost, let's say this is not that. So what happened? Who are these banks and why did they get in trouble? To understand that, our story starts really about 3 years ago with the onset of the pandemic. Okay, if you all remember, the pandemic happens, everyone's very scared, stock market kind of plummets to start, but then immediately what starts happening is all these new technologies and all these new ideas start coming out, right, in our new normal. For instance, Zoom, right now that I'm recording this on, right? Zoom became a great name. A lot of different companies in the tech sector, now that everyone was having to be remote, the work from home, there was really a rise in that. So there became lots of interest, lots of investment in those companies. In addition, cryptocurrencies, all the companies associated with it and crypto adjacent out there, lots of money started flowing to these companies, either through investments, through venture capitalists, through hedge funds, or through the stimulus that came into the economy. So some of these banks that were very focused into these areas, like we have here, Silicon Valley Bank, and the other bank that Signature, I believe it was, that basically have now failed and have been required to be taken over. They received tons and tons of deposits. Okay, they basically, I think some of the numbers are talking about out there, they doubled or almost tripled their deposits in a very short period of time. So while that's great, for the bank to say, hey, listen, we have these deposits, what's then required of them is they need to take those deposits and they need to invest it, right? Because the banks do not have to have all the cash on hand, right? If you understand banking rules, they do not have to have all the cash on hand for that, the demand of their depositors. They can invest some of that money and they also lend out that money, right? And that's how banks make their money. And so typically when interest rates rise, that's good for banks. But what happened here is, especially these particular banks, is they went and made investments, and they made investments in very, very secure investments, basically in US treasuries, okay? Now, the problem was, and what they didn't anticipate was they didn't anticipate how quickly interest rates would rise. And let me share something right here just to show what we're talking about and kind of somewhat, the unprecedented nature of what happened last year. The Federal Reserve came out at the beginning of last year and said, hey, listen, we got inflation wrong, right? It's not transitory, it's really here to stay. So really the Federal Reserve, the only tool they have to kind of moderate and combat inflation is to raise interest rates. And so what happened was the interest rates rose from 0 to about 4.5% last year. Now, that total interest rate rise is not unique. Okay, it's happened many times in the past. You'll see here on this different chart. But what was unique was the speed in which it happened. Okay, it went up in 8 months, whereas a similar interest rate hike went almost 25 months in previous tightening cycles. Okay, that was what was unexpected. That's what a lot of people didn't see. And so you see here the bond market, right? This is not necessarily what these banks were invested in, but the bond market pulled back over 15%. To have this year, where a bond market and the stock market to pull back over 15% in the same year hasn't happened in many, many, many decades. So that was unexpected. Okay, so what happened was these banks, they made those investments they probably, to try to get a little better interest rate, they were buying longer term treasuries, right? Maybe that mature over 5, 6, 7 years. And what happens with a bond is the bond moves, inversely to interest rates. Interest rates go up, bond prices go down. Okay. Now, if you hold that bond to maturity, you're fine, right? You're going to get your money back. You're going to get what the par value was, what that company. But when you hold bonds that have a longer period until they mature, they are more sensitive to interest rates. Okay. So that's what happened here. These investments on the balance sheet of these banks were more affected than many other banks that were out there because they were longer bonds. Now, what's another nuance that happened here? There's these rules in banking. Now, listen, we're not here to comment on whether this is right or wrong, whether it should or should not be. These are just what it is. A bank can buy a bond and hold it on their balance sheet at the value that they paid for it. Okay? If so long, they're going to hold that bond until it matures. There's another group of bonds they might have that they say, hey, listen, this is readily available for us to sell, to fund our operations. Okay? So those are another pool of investments. In these that you hold to maturity, if the value of that bond goes down in price, you don't necessarily have to show that on your balance sheet, okay? Until you move it over to this other bucket that you're ready to sell it. And so that's what happened here for Silicon Valley Bank, is that because of, there was a requirement that they need to fund their operations because a lot of their clients, they were focused in the tech sector. This is another important issue. Those tech sector clients have been bleeding cash, right? So the deposits have been going down. They've been using their money. So the bank then needed, because their deposits went down, they needed to sell those bonds to fund the depositors, okay? The ones that to meet those ratios and to stay in line. But when that happened and they move it to this other side of the balance sheet, all of a sudden now you see, oh, they've lost value. And then you start seeing, then the words, conversations go out there, oh my gosh, what's happening with the bank? What do we need to be concerned about? And then what happened was we had a good old-fashioned bank run. All the people for these banks, they said, hey, listen, let's run over. We want to get our money out of the bank. I think last Thursday alone, almost 40 billion left the bank. And remember, this all started because so much money came in so fast. Now this money is leaving so quickly. And so what happens? They say, hey, listen, we can't handle this. This is not, we can't function like this. There's too many people come running on the bank. So boom, we throw our hands up, federal government, come take us over. Okay. So that's what happened. All right. This wasn't anything systemic in the banking system. That was the nuance of what happened with these banks and exactly, what happened. So now we've learned yesterday the federal government is going to come in. They're going to make loans to these institutions. They're going to take out management, which management is very much to fault for making those longer term investments. And they're going to give these banks and depositors time to recover and get their deposits out, which probably would have happened regardless if the bank did not have to satisfy those withdrawals so quickly. They were going to try to issue stock, right? They were going to try to issue additional debt. And that's normally how a bank functions, okay? So that's what, that's kind of what happened, all right? And so everyone understands, and there's these certain banks, it was poor management. It was unexpected because of interest rates. And then it was a good old-fashioned bank run. And guess what? This isn't like the Great Depression where people go into their local bank and ask for the cash to be taken out of their accounts. This was all happening online. So the speed and pace on which money can move nowadays is kind of unprecedented. So that was a confluence of factors. A lot of people, did not see that potential out there. But in what's happening in the economy with the Fed raising rates, we're learning in this new economy, there's always unintended consequences. And so that's what happened. Now, what can you do, right? What can you do now? Hey, listen, I'm concerned. This bank went under. What about my banks? Okay. So first and foremost, understand FDIC coverage. If you are one depositor at one bank, an individual, you have FDIC coverage. They cover you up to $250,000 if you are solely on that account alone. If you put another owner, there's an additional $250,000, so that's $500,000. So number one, you want to look at and understand FDIC coverage. Okay, I'm putting links to these underneath this video. If you want to link and you want to learn about this more, please, go do that. Regarding your investment accounts, okay, understand they're not covered by FDIC, but there is other insurance called SIPC, the Securities Investors Protection Company, which does provide that kind of protection to investment accounts up to about $500,000. And then most custodians have insurance way above and beyond that, but that works different. And I'll talk a little bit about that too in a second regarding your investments versus your deposits. One thing that's kind of interesting that I think a lot of people are not aware of, and this has been around for a while, and I think it became the conversation wasn't that acute because everything was fine, right? After the financial meltdown, everything was going great. We were on this bull market run. The banks were too big to fail. They got recapitalized, whatever it might be. There is this these functionality, these networks, which go by ICS or CDARS. Okay, they're both. There's intercompany, I believe ICS stands for, and the certificate depository. I will put links once again to this in the video below. But what happens is, and understand the functionality of this, is you want to have a bank that participates in this network. Because even though you have that $250,000 limitations, for ones that invest in this network, is you put $1 million in the bank and you tell them, hey, listen, I want that all to be protected by FDIC. They then go behind the scenes and they take $750,000, for example, and they place it in each one of these other 3 banks, right? So they kind of, as I was explaining this to my wife, the other day, it's kind of like a bookie, right, in a casino, that they get a lot of action. They get these heavy bets, right? But they want to lay off those bets. They want to lay off that risk. So the banks lay off this risk to other banks, so that basically you're in bank A and it says you have $1 million, but basically all $1 million is not sitting at that bank. 750 is sitting at other institutions, okay, to give you that kind of coverage. So that's something that you want to be aware of, and ask your bank to see if they're a part of that. Another thing that we've been doing, for a lot of clients in our business, and this goes back to the explanation of the SIPC protection before. Understand that your deposits at a bank are the assets of the bank and are subject to the creditors of the bank if something goes wrong with them, right? Because your money is not actually there, okay? Now, with investment accounts, it's very different. When you own Apple, when you own Microsoft, whatever there might be, if you own those individual securities, if anything happened with the custodian, you would receive those securities back because you own them. So something that we've been doing a lot of clients for safety is, as we explained, what the banks did, they've been investing in short-term treasuries, not long-term treasuries, right? Because there's that interest rate, you don't want the valuation to stay kind of steady, and to invest directly in those treasuries. And then as they roll off every 3 months or so, you reinvest them into treasuries. So you have that safety because you actually own those assets. Okay. And that's what you have. So those are some ideas on, a little bit of explanation of what happened. These are some ideas on what you can do. If you have any other questions, listen, we're happy to have a discussion with you and talk about this, or reach out to your bank, reach out to your own financial advisor, find out what those options are out there, because there are a lot of options. This is not like it was in 08 and 09, but this is probably a good time to look back to say, hey, are there gaps in my plan? Is there something that I didn't account for, some unexpected risk that I'm not addressing? That's what happened to these banks, right? They weren't ready for it. They didn't anticipate these confluence of factors of asset prices going down, money going out, and then depositors asking for more of the money. So, take some time, go through it, figure out what your plan is, and then I think you'll feel a lot better. Thanks.